Governments want you to believe they control money. They print it. They regulate it. They promise to defend it. But on September 16, 1992, Britain learned the truth. When markets lose faith, governments are powerless. And one trader made a fortune proving it. Welcome to Financial Story, where money, power, and history collide, and nothing is ever as simple as it looks. Most people think central banks are invincible. They have centuries of institutional credibility, armies of economists, and the ability to move billions with a single statement. They exist specifically to protect national currencies from collapse. And when a crisis hits, they tell the public the same thing every time. Trust us. We have this under control. But on September 16, 1992, the Bank of England discovered something terrifying. Control is an illusion. And when that illusion breaks, no amount of money, no amount of intervention, and no amount of credibility can put it back together. On that single day, Britain spent nearly £27 billion trying to defend its currency. They raised interest rates twice in a matter of hours. They bought pounds by the billions, dumping foreign reserves into the market, and still they lost. Not to another government, not to a war, but to a hedge fund manager sitting in New York who had done something governments hate. He had looked at the numbers honestly. That man was George Soros, and by the time the sun set on Black Wednesday, he had made over $1 billion. Britain, meanwhile, had suffered one of the most humiliating financial defeats in modern history. But here's what matters. Soros didn't break the Bank of England. The system was already broken. He just had the courage to bet on it. And that distinction between cause and symptom is something governments never want you to understand. To understand how one man defeated an empire's central bank, you need to go back to the 1940s, to the rubble of World War II. After the war ended, the global financial system was rebuilt at Bretton Woods, a conference in New Hampshire in 1944. The new order was simple. The US dollar would be backed by gold, and every other major currency would peg itself to the dollar. It created stability. It allowed Europe to rebuild, and for nearly 3 decades it worked. But by the 1970s, the system had become unsustainable. The United States was printing dollars faster than it had gold to back them, funding wars in Vietnam and social programs at home. So, in 1971, President Richard Nixon did what governments always do when reality becomes inconvenient. He changed the rules. He severed the link between the dollar and gold. From that moment on, every major currency in the world became fiat, backed not by precious metal, but by trust in government promises. And trust, as history repeatedly shows, is the most fragile asset of all. By 1990, Europe had a new dream: economic unity. The goal was a single currency, the euro, and a seamless economic zone where goods, capital, and people could move freely. But before that dream could become reality, European economies needed to converge. They needed similar interest rates, similar inflation levels, and stable exchange rates. So European governments created the exchange rate mechanism, or ERM. It was a system that locked European currencies together in fixed bands. If your currency started to drift too far from the agreed rate, your central bank was expected to intervene, buying or selling currency to maintain the peg. Britain joined the ERM in October 1990. The pound was pegged to the German Deutsche Mark at a rate of 2.95 marks per pound. The British government promised the markets this rate was sustainable. They promised they would defend it. They promised stability. They were wrong. The problem was simple but brutal. Britain's economy was not Germany's economy, and the ERM treated them as if they were. Germany, freshly reunified after the fall of the Berlin Wall, was booming. Its economy was overheating. Inflation was rising. To cool things down, the Bundesbank, Germany's central bank, raised interest rates aggressively. Britain, meanwhile, was sliding into recession. Unemployment was rising. Growth was stalling. What Britain needed was lower interest rates to stimulate the economy, to encourage borrowing and investment. But the ERM didn't allow for that flexibility. If Britain lowered interest rates, investors would sell pounds and buy Deutsche Marks, which offered higher returns. The pound would weaken. The peg would break. and Britain would be forced out of the ERM in humiliation. So Britain was trapped. It could raise rates to defend the peg and deepen the recession, or it could lower rates to help the economy and abandon the ERM. Either way, someone was going to suffer. The government chose to protect the peg. The British people would pay the price. By the summer of 1992, the strain was showing. Unemployment had topped 10%. Businesses were failing. Homeowners were defaulting on mortgages. And the markets were starting to ask a very dangerous question. How long can Britain sustain this? Traders began to smell blood in the water. George Soros had been watching. And unlike the politicians making promises on television, Soros didn't care about credibility or reputation or national pride. He cared about numbers, and the numbers didn't lie. Britain's economy was too weak to support high interest rates. The peg was unsustainable. Eventually, something would break. The only question was when. Soros made a decision. He would bet against the pound, not with his own money alone, but with billions in borrowed capital. He would short the pound, borrowing it and selling it, betting that its value would fall. If he was right, he could buy it back cheaper later and pocket the difference. If he was wrong, the losses would be catastrophic. It was a massive, calculated gamble, and Soros wasn't alone. Other hedge funds, seeing the same cracks, began piling on. The selling pressure mounted. On the morning of September 16, 1992, the floodgates opened. Traders sold pounds in enormous volumes. The Bank of England tried to fight back, buying pounds with its foreign reserves, trying to prop up the price, but it was like trying to hold back the tide with a bucket. The British government raised interest rates from 10% to 12%, hoping to make holding pounds more attractive. It didn't work. Hours later, they raised rates again to 15%. Still, the pound kept falling. By mid-afternoon, the game was over. Britain couldn't sustain the defense. The reserves were draining. The economy couldn't handle 15% interest rates. The government had no choice. At 7 p.m., the Chancellor of the Exchequer appeared on television and made the announcement. Britain was suspending its membership in the ERM. The pound was no longer pegged. It would float freely. In other words, Britain had surrendered. The pound immediately fell by 15%. Billions in reserves had been spent for nothing. The government's credibility was shattered, and George Soros, along with other traders who had bet against the pound, walked away with staggering profits. Soros alone made an estimated $1 billion in a single day. But here's what often gets missed in the retelling. Soros didn't cause the crisis. The crisis was already there, baked into the system the moment Britain entered the ERM with an unsustainable peg. The politicians knew it. The economists knew it. They just hoped they could maintain the illusion long enough for something to change. Soros simply refused to play along with the illusion. And when governments build policy on wishful thinking, someone always profits from the collapse. The lesson of Black Wednesday isn't that traders are villains. It's that governments cannot defend the indefensible. When a currency is overvalued, when an economy is trapped by bad policy, when promises are made that reality won't support, no amount of intervention can hold the line forever. Markets are not moral. They don't care about national pride or political commitments. They care about one thing: whether the numbers add up. And when they don't, the reckoning is brutal and swift. We've seen this pattern repeat again and again. In 1997, the Asian financial crisis unfolded when Thailand tried to defend an overvalued currency peg and failed. In 2001, Argentina's currency board collapsed under the weight of unsustainable debt. In 2018, Turkey watched the lira collapse as confidence evaporated. And every time, the script is the same. Governments promise stability, markets lose faith, and ordinary people pay the price while a few position traders profit. The uncomfortable truth is this: your money is only worth what others believe it's worth. Governments can print it, regulate it, and defend it with all their might. But if the market decides the promises are empty, no central bank on earth can force belief. George Soros didn't break the Bank of England. He just stopped pretending it wasn't already broken. History doesn't repeat. but the incentives do. Governments will always be tempted to make promises they can't keep. Markets will always punish dishonesty eventually. And those who see the gap between rhetoric and reality will always profit from the collapse. If this gave you a new perspective, subscribe. History has the answers, and I'll show you where to look.